So is it now time to start putting some money into beaten down energy stocks? And if so, into what sector of that sector? Rob Fummel is portfolio manager of the Tortoise Energy Evolution Fund, which is rated 4 stars by Morningstar. Fund down about 16% this year. That is not nearly as much as the energy sector as a whole. There you see its price action. Rob, welcome. Good to have you with us. You run an energy fund. I assume you're going to tell me that this is a good time to buy energy stocks, or at least some of them.
Well, yeah, of course, Tyler. No, energy is just an essential good, if you think about it, Tyler. Obviously, nothing works without energy. We all need energy for our lights to turn on, for our air conditioners to run, especially at this time of year. Obviously, the energy sector has suffered, especially this year, as there's a lot of uncertainty with regards to global energy demand. And so that's pushed the stock prices down, it's pushed oil prices down, natural gas prices down, which really offers an opportunity, we think, for investors, because we do know that going forward, in a post-COVID world, we are going to demand and consume more energy globally.
So let's talk about where energy fits in a person's portfolio. As people go and assemble a portfolio, maybe you've got 30% in an S&P 500 fund. What percentage of your capital, your invested capital, is prudent to put into a single sector, namely energy?
Yeah, so if you look at the energy as a representation of the S&P 500, it's like 2.5% or something along those lines. But at Tortoise, we actually widen how we look at energy. We don't just look at energy as oil and gas producers. We think the energy sector encompasses everything from oil and gas producers to midstream pipeline transportation companies, refiners count in that, but also electric utilities, and electric utilities both domestically and globally. So when you factor all of that in, a 5 to 10% allocation to energy, we think is reasonable in this environment. The other thing, Tyler, that I think
with
energy offers.
Go ahead.
Sorry. Go ahead.
Go ahead, Rob. Go ahead. No, please.
What I was going to say is the one thing that energy offers that other sectors in the S&P 500 do not is current income to investors, and we think that replacing current income today is really important, because obviously a lot of dividends have been cut in some sectors. Obviously, the 10-year Treasury is very low. The bond yields are very low. But if you're very selective in energy, you can find some really good companies that offer some really high current income levels, 8 to 9% dividend yields. We think that's attractive, and that should be part of everybody's portfolio from an investing perspective.
And that's where I want to go. That's where I want to go next with you, Rob, because some of the picks that are, I assume, in your portfolio are precisely those kinds of choices with 8 and 9% dividend yields. Give me those names and tell me why you're confident that those 8 and 9% dividend yields are secure.
Yeah, so at Tortoise, we focus a lot on the company's cash flows, because one of the things that is going to really bring the energy sector back and have investors be interested in the sector is free cash flow from the sector. So a name like Enterprise Products Partners is one of our favorite names. It's about a 9% dividend yield. But what you have to look at when you look at all dividend-paying stocks that have high current income, you have to look and make sure, even in this low environment where obviously energy demand's down, can the company generate sufficient operating cash flow to obviously pay its dividend and fund its capital? So in other words, they're not increasing debt to pay their dividend. A company like Enterprise Products is doing that exact thing. They're not raising debt. They're generating ample cash flow to pay their dividend, fund their capital expenditure program. And we think that those are attractive type of names. The infrastructure assets that Enterprise operates are very critical. They're important, and they operate some really essential export facilities that will be really important going forward.
One final quick question, if I might. I took note of what Berkshire Hathaway did a couple of weeks ago in a transaction with Dominion. I believe they bought Dominion's, I think it was transmission assets for $9.8 billion, including debt. What is Berkshire's play here in energy? And by contrast, what is Dominion's?
Yeah, well, you're exactly right. So Berkshire bought natural gas pipelines. And so at Tortoise, we look at the energy sector right now, and we are in a transition, no doubt about it. And as a result of that, we think going forward, you're going to need more natural gas and renewables, basically, and displace coal. And as a result of that, you'll be able to generate more energy and less carbon emissions. And so what Berkshire, I think, said is natural gas going forward is a really critical fuel and will help not only just the U.S., but the world consume more energy with less carbon, because natural gas produces half the carbon that coal does, and obviously renewables produce zero carbon. So that longer term theme and this transition that plays out over a series of several years, we think is what really what Berkshire is looking at, and seeing significant demand for pipelines like natural gas pipelines coming out of a critical basin like the Marcellus Shale here in the U.S.